Hi, everyone. I'm Tony Welch, Chief Investment Officer at Signature FD. And this week, I want to focus on a simple but important idea. For much of the last 2 years, markets have enjoyed a powerful tailwind that rarely did make the headlines, and that was that inflation was steadily moving lower. Now, that trend helped consumers to feel better, gave the Federal Reserve room to step back from their aggressive tightening campaign, and quietly supported stock prices. But last week, that story did become a little more complicated. Inflation data came in hotter than expected. Oil prices remain elevated because of geopolitical tensions, and investors are beginning to ask an important question. Was this just a temporary flare up, or is inflation becoming a bigger issue again? Now, before we jump to conclusions, I think it's important to remember something here that markets don't move on inflation alone. Earnings remain strong. Consumers are still spending, and the economy continues to hold up better than many expected. So while the road forward may become bumpier, we don't think that the broader story has fundamentally changed. So, starting here with inflation, for most of this bull market, inflation steadily moved lower, and that did a lot of the heavy lifting for to support valuations and stock prices. Now, markets tend to care less about how high inflation is and more about whether inflation is getting better or worse. So, think of it this way. Investors can usually adapt to inflation if it's moving in the right direction. What creates problems is when inflation begins accelerating again after everyone thought that the worst was behind us. And that's why last week mattered from a data perspective. Both consumer prices and producer prices came in hotter than expected. Now, energy prices tied to Middle East tensions clearly are playing a role, but businesses are also beginning to feel higher transportation and supply chain costs. Now, the encouraging news is that we're still not seeing what economists call second round effects. And that's just a fancy way of saying inflation is not meaningfully spread into wages or long term inflation expectations. Now, why does that matter? Because there's a big difference between an inflation scare and an inflation spiral. And right now, this still looks more like an inflation scare. It deserves attention, but it's probably too early to assume that the playbook has fundamentally changed. So, if inflation is heating up, why are stocks still so well behaved this year? Well, the answer starts with earnings. First quarter earnings season has been notably strong, and importantly, participation has been broad across sectors. Companies continue to beat expectations, and that helps explain why stocks have remained resilient despite higher inflation headlines. But there's another dynamic here that I think is getting overlooked. Stocks are actually not becoming more expensive this year. In fact, valuations have drifted a bit lower because earnings growth has been so strong. So, put differently, companies are growing into their valuations rather than relying entirely on investor enthusiasm to push the stock prices higher. Now, this doesn't mean that inflation suddenly doesn't matter. Historically, higher inflation has often caused investors to pay less for every dollar in earnings. In market speak, inflation pressures valuation multiples. So, yes, inflation can absolutely create a tougher backdrop. But for now, strong earnings are acting as something of a shock absorber for the market. And earnings aren't the only support. One of the more surprising themes this year has been how resilient the economy continues to look. Consumers are still spending. The labor market remains stable. Retail sales suggest that growth is slowing only modestly here, if at all. And that doesn't mean there aren't risks. Higher oil prices can eventually pressure consumers, and sticky inflation could weigh on confidence. The Federal Reserve, which likely remains on hold for a while, could remain on hold for even longer than investors would prefer. But at least today, the economy looks more like it's moderating than actually deteriorating or heading towards a recession. And that distinction matters. Markets tend to struggle most when growth is breaking down. And we simply are not seeing clear evidence of that right now. Now, another concern we hear a lot is that this market is really only being carried by a handful of mega cap technology or AI stocks. And there's certainly some truth to that concern. Leadership has been concentrated, particularly around artificial intelligence and large tech companies, but the reality underneath the surface is more nuanced. Market breadth, or how many stocks are actually participating in the rally, has been healthier than many people assume. No, participation isn't exceptionally broad, but it's also not nearly as narrow as the headlines often suggest. And historically, broad market gains have often been driven by a relatively small number of the largest companies, simply because they carry so much weight in the index. What matters more is whether participation completely breaks down, and at least for now, we're just not seeing that. The bigger shift may actually be investor psychology. So earlier this year, investors were skeptical. Sentiment was cautious. Markets could continue climbing, even in the face of uncertainty, because those expectations were relatively low. And that backdrop has seemingly changed a bit. Investor optimism has returned quickly, and ETF inflows have strengthened. Investors have become eager buyers of pullbacks again. Now, importantly, optimism is not necessarily bearish, but it does tend to create a market that becomes more sensitive to disappointment. When expectations are low, markets can ignore bad news. When expectations rise, surprises matter more. And that doesn't mean trouble is necessarily coming, but it may mean that the next phase of this bull market feels different, less about broad momentum and more about patience, selectivity, and fundamentals. So, what's the bottom line? Inflation has clearly shifted from a quiet tailwind to something we need to monitor more carefully. And that deserves attention, but it doesn't automatically mean that the bull market is over or that investors should become defensive. Strong earnings continue to support the market. Now, consumers are still spending and the economy remains resilient, and market participation beneath the surface continues to look a bit healthier than many of the headlines imply. Now, we do think the path higher may become bumpier, and this may be a market that becomes a little less forgiving for disappointment given the optimism that's baked in. But at least from where we sit today, this still looks more like a constructive backdrop than the beginning of a major deterioration. If the first phase of this rally was about those easy gains fueled by improvement and inflation, the next phase may be more difficult to come by those gains, but supported by strong fundamentals. As always, I want to thank you for listening and joining us and wish you a great week ahead.